Good morning, ladies and gentlemen. Well, 2 weeks ago I said that we had to get very bullish. Last week we said that 28.64 should be the level that trades. It happened. My level of conviction from now on decreases in my predictions simply because the trend is getting old. But just because the trend is getting old does not mean that you have to reverse your opinion. It just means that you have to lighten up on positions and wait for a market signal to occur, which it hasn't. The risk dial is still very negative. It might improve slightly, but that makes no difference, as we shall see in the deviations. Basically, you have to stick with it because the trend is established. The trend in risk for the moment is up, but it is now fighting the intermediate and long-term trends, and that to me signals a lower level of volatility than we've experienced for the past month or two. But still, we have to let the market guide us and find levels at which it is, you have a very high degree of probability of being right as opposed to being just squeezed, which is what people are being at the moment. Well, what always happens in deviations at some stage has happened, and that we've touched the center line in the SPY. To me, that suggests that we will now meander around it, but that does not mean I'm bearish. It just means that we will see ups and downs, that we will see trading conditions as opposed to trending conditions. Does not mean that I'm bearish, but what it does show me is which the leaders are, and this is XLE, obviously a laggard. The telecoms, equal weight, and XLU also equal weight, XLB more or less equal weight, and here we start with the leaders. XLK is a leader, XLF an obvious laggard, but my contention is that this cannot persist. XLF cannot continue being a laggard, because if things are better than we think, then XLF is hugely undervalued. And here is a leader, XLV, and XLP, and even XLY has started becoming a leader, but there again I think that this one is not going to continue being a leader, simply because I think it's going to take a long time for the economy to get back to normal, and I think purchasing power is probably something that we're going to be very short of for quite some time. And XLI, an obvious laggard. XLC, not important. XLRE, I think this one is pretty much shot its bolt. IWM, an obvious laggard, but I think that again, together with XLF, that has to catch up at some stage if this is a true recovery. QQQ, an obvious leader, but it's getting to levels where it's not all that attractive. This kind of area where it's traded so much before it did a quick spurt is going to be very hard to break over the long term. And EEM, obviously another major laggard, and I think it will continue to remain so. The yield curve is not giving us any clues at the moment. It's not breaking any important levels. This area between 36 and 30 to me is very important. Below it, I think we are in risk off, which basically means the equities are in danger of being hit at any moment. And above 75, I think that we are in extreme risk on, and we are nowhere. We are meandering here. I I think every time it gets down to this 35 level, the risk reward is for a bounce. I really can't see it breaking the 30 level for a considerable period of time unless something big changes in the market. But to me, this is certainly going to be one of the leading indicators that I'm going to put a lot of faith in for the next few weeks and months. Just like the yield curve hasn't done very much last week and is basically telling us to keep positions as they are, here we have another indicator that I showed you last week, which has not got to levels which are interesting for a trade. This is SPY TLT. I said that not until it gets to this 183 level or very close to it that I could see a danger for equities, i.e. that they are overbought relative to SPY. We did nothing last week, absolutely went sideways. I half expect a lunge up to these 180, 183 levels, and I think there it probably will be a question of taking on a long trade in bonds as opposed and a short trade in equities. The risk reward here is going to be very good. The same thing appears in this SPY over IEF, which is the 7 to 10 year, closer to this 250 area. This 250 area has always been very, very good for a trade either way. We are, what are we, 238-ish, 235-ish, another few percentage points and we can, these two will probably coincide, and that will be the time to probably go long of bonds and short of equities. Most of the time it pays to keep things simple. This is the S&P. As you can see, basically it's doing a perfect ABC retracement with the 100% objective around 2900. And this is the 2864 to the 2950 range, which basically saw so much trading and where a huge amount of volume is that people traded and therefore is a natural resistance level. To me, 2864 is very important, and I think what I'm saying now is that we will be sick of seeing 2864. It'll gyrate 75, 100 points through 2864 and back down through 2864 for the same amount. You can see how important this 27, 20 kind of level is. And to me that is actually, and you will see later that that is going to be the divider between the bull trend line and bear trend line. But I think the likelihood of seeing something like this and something like this over the course of the next few weeks is very high. Simply because the trend is going to keep on going on until it's broken. As you saw on Friday, the market backed off that 2864 level beautifully, went down to 28, 20, 22, 25, which I said was the likely level to we were going to get before the market decided whether it was going to go straight through it or bounce straight back to 2864. We got the bounce straight to 2864. Why? Because people keep on getting squeezed out of their positions. People are actually still bearish for some reason. I don't know why they're bearish, but they're still bearish and they keep on getting squeezed out. So unless we start breaking some very significant levels, we will keep on, rallying back up to these levels, 2864 and 2948. To me, it's very likely that we see a lot of trading with smaller trading ranges than we have become used to in this part. Basically, what the market is saying, all that happened here was rubbish, and we are now at where we were, which was some kind of value proposition area. To me, I never understood why people were as bearish as they were in this part. To me, it was obvious that this was stops, and at some stage we would come back. Now that we have come back, the question is, do we have enough momentum and do we have enough reason to keep on going? For the time being, I don't see it. I'm prepared to be proved wrong, but what I'm not prepared to do is fight this trend until the technicals tell me that it's time to do so. This is the S&P again. I'm sorry this chart is such a mess, but the levels are all marked here, so that's why to me they're so important. 2864, that line, 2954, that line. Now, as you can see, the 100% of the ABC objective is 2900, and then we have this area of congestion between 2863 and 2954 if we go much further back. And above it we have this mauve line, which is the 200-day moving average, which is trending down. To me, the most important line is this red one. While we are above it and it's now beginning to trend up, we are in a bullish period. You can see how as soon as that Monday we broke through this red moving average, we could never ever close below it. Every time we touched it, we bounced straight up. It's pretty obvious to me that these couple of lines are going to be very, very important, and at the moment they're coming in around the 2720 area. If you have a look at what's been happening, basically we had a rally up, and then we have had a slow push higher where people have been squeezed out of their positions. We have 1, 2, 3, 4, 5, 6, and we'll probably have something like 10 days between something like 2954 and this level here, which is the 2725 level, which to me becomes the level below which the market has to trade for me to get even remotely bearish. Now, lightening up positions as we go up to 2954 or even 2864 is not the same as being bearish. I will do a bear trade, but it's a trade. Being bearish means you want to sell all the rallies and you want to be positioned short for a move which I would then think goes straight back to this 2475 area in a big hurry. At the moment I don't see it. At the moment I think the market is more likely to do this and respect the 2725 level very strongly, and therefore I'm not going to get bearish. I'm going to have some bear trades from very good levels, but I'm just not going to be positioned short. And this is why I said at the beginning that we're beginning to fight the intermediate and longer term trends. On a weekly basis, we are now coming up to this very important red line, which is trending down, and it's coming in, next week it'll be somewhere below 2952. The market, to return to a bull market, we have to take out these moving averages, the highest one of which probably is going to be around 3025 next week. I really can't see 3025. I might be wrong. That actually would be beginning to be really bullish. I can't see it. I think we have too much indecision. I think we have too many uncertainties. I think the way the bond market is positioned and the yield curve would not allow for the resumption of a strong bull market in such a short period of time. I think the likelihood of a lower range week, and you can see how we had this spurt, and actually last week was a much lower range week and we gained much less. The possibility of a continuation up to 2950 and then a move back down to 2964 is probably what we are in for. I think we might be trading around, up and down, around the 29.64 level for quite a few weeks before we decide whether we retest the low or we break this area, and then we are in a V recovery. Why would we get a V recovery? I have my ideas and I will share them with you on the stream next week, but I think it's the lesser probability of the consolidation between, say, 29.50, 30.25, 28.64 and then 27.25. I think we will be sick of trading these levels for the next 3, 4, 5 weeks. Let's see if I'm right. But, and here we have the confirmation of the importance of these levels. If we enlarge this chart, and this is a monthly chart of the S&Ps, what are we seeing? We're seeing these levels are going to be very, very difficult to break. I think we are in for maybe something like this, i.e. months of trading up and down within them. I really don't think it's going to be very easy to get out of this range. But what I do think is that the Fed has put in a floor. I don't think we will see below 2500, 2550 even for at least 2 or 3 months before we make a major move, which will be either higher or break that level. I think for the next even 2-3 months we are in this kind of a pattern, where we traded 1, 2, 3, 4, 5 months, 6, 7 before we got a trend. I think we are going into a much quieter period. How are we doing on the volatility predictor? Well, my idea is still now that if we don't rally any higher than, say, 50 over the course of the next several weeks, we are doing one of these right up here. We're emulating that kind of trading, in which case this will be like an A, B, C down hard, and then if that is all we get over the next 2, 3, 4 weeks, that basically that the demand for protection is the left tail does not go berserk. In that case, I think that by year end we will be back down into the teens, and that to me will signal the beginning of a new monthly rally. If we can't get any higher than 50 on bad news, and we will have some bad news, we'll have some bad days in the market, that means that the next stop is going to be around the 22 area, and that would tell me that we are in for a very rapid V, and that we will make new highs by the end of the year, which is probably what people are least expecting. I'm still longer term bullish. I still think that that humanity will beat this virus hands down at some stage. The only question is one of timing, and the only question is how long do we persist in basically stopping everyone out on the upside and the downside. I think it's going to take several more weeks of that range that I just showed you in the S&Ps before we are ready to make a break, probably until the end of the summer. And that is really all I have to say at the moment. My conviction level from a couple of weeks ago has gone down as the market has gone up. I can see it a little bit higher. I can't see it much higher. I will keep an eye out on that SPY TLT, SPY IEF, because that should give us a good trading opportunity to go short of equities at some stage. If we get there, and if that matches with that 29.50 level, I'll be very happy. Thank you very much indeed, and I'll tweet you on Monday.